What's the best way to keep more of your investment gains and pay less in taxes? Taxes can take a big chunk out of your returns if you're not careful. But with the right strategies, you can minimize that hit. In this video, we'll cover some of the best tax strategies to help you maximize your investment returns. From using tax-advantaged accounts to taking advantage of lower long-term capital gains rates. These tips will help you keep more of what you earn. Stick around and let's break down how you can make smarter moves to grow your investments and save on taxes. Let's get started. Practice buy and hold investing. You've probably heard that patience pays off, and when it comes to investing, that couldn't be more true. One of the easiest ways to minimize your taxes is by simply holding onto your investments longer. This is called a buy and hold strategy. Instead of constantly buying and selling, which can trigger more taxes, holding onto your stocks or other investments lets you defer paying taxes until you actually sell them. The beauty of this approach is that it allows your investments to keep growing without the burden of taxes slowing them down. And when you do eventually sell, you'll benefit from the lower long-term capital gains tax rates, which are much more favorable than short-term rates. In short, the longer you hold, the more you keep. It's a smart, low-effort way to maximize your returns while minimizing the tax hit. So if you're looking to grow your portfolio without giving too much to the taxman, buy and hold is a strategy worth considering. Utilize tax-advantaged accounts. When it comes to saving on taxes, tax-advantaged accounts are like hidden gems. Accounts like IRAs, 401(k), and Roth IRAs can make a huge difference in how much of your money stays in your pocket. With traditional IRAs and 401(k), the contributions you make are tax-deductible, which means you're lowering your taxable income today. Plus, the investments grow tax-deferred until you withdraw them in retirement. On the other hand, Roth IRAs work a little differently, but are just as powerful. With a Roth IRA, you pay taxes upfront, but then your money grows tax-free. And when you take it out in retirement, you don't owe any taxes on it. That's right, completely tax-free withdrawals. Using these accounts is a smart way to grow your investments while minimizing your tax burden. Whether you want to lower your taxes now or enjoy tax-free income later, these accounts offer flexibility and significant long-term benefits for any investor. Take advantage of tax loss harvesting. Nobody likes seeing their investments lose value, but there's a way to turn those losses into something useful: tax loss harvesting. This strategy lets you sell investments that have gone down in value and use those losses to offset gains from other investments. By doing this, you can lower your taxable income and reduce the amount of taxes you owe. Here's how it works. Let's say you made a nice profit on one investment but lost money on another. You can sell the losing investment and use that loss to offset your gains, which means you won't owe as much in capital gains taxes. You can even use up to $3,000 of those losses to reduce your ordinary income for the year. And if your losses are more than that, you can carry them forward to future years. Tax loss harvesting is a smart way to make the most of a down year for your portfolio, turning a negative into something that actually saves you money. It's a helpful strategy for keeping your tax bill lower while managing your investments efficiently. Consider asset location. Ever think about where you're holding your investments? It might not seem like a big deal, but the type of account you use can have a big impact on how much you pay in taxes. This is called asset location, and it's all about placing the right investments in the right accounts to maximize your tax efficiency. For example, tax-inefficient investments like bonds and real estate investment trusts (REITs) tend to generate income that's taxed at higher rates, so it makes sense to hold these in tax-deferred accounts like IRAs or 401(k), where the income can grow without being taxed right away. On the flip side, tax-efficient investments like index funds are better suited for taxable accounts since they don't generate as much taxable income. By being mindful of where you hold your investments, you can reduce your tax liability and keep more of your money working for you. It's a simple but effective strategy that can make a difference in how much you pay in taxes each year. Use a 1031 exchange for real estate. If you are a real estate investor, paying capital gains taxes when selling a property can feel like a big hit. But with a 1031 exchange, you can avoid that immediate tax bill. This strategy allows you to reinvest the proceeds from a sold property into a similar one and defer the capital gains taxes. Here's how it works. Let's say you sell a rental property for a nice profit. Instead of paying taxes right away, you can use that money to buy another property of equal or greater value. By doing this, you defer the capital gains taxes and keep your money working for you in your new investment. It's a great way to grow your real estate portfolio without losing a chunk of your profits to taxes. Using a 1031 exchange not only keeps more of your money in play, but also lets you continue building your wealth over time. It's a smart move for investors who want to expand their real estate holdings while keeping taxes at bay. Maximize contributions to retirement accounts. Maxing out your contributions to retirement accounts is one of the easiest ways to boost your savings and lower your taxes at the same time. Accounts like 401 and IRAs offer huge tax advantages. With a traditional 401 or IRA, your contributions are tax-deferred, meaning you don't pay taxes on that money now. It grows tax-free until you withdraw it in retirement. Roth IRAs work a little differently, where you pay taxes up front but enjoy tax-free growth and withdrawals later. Either way, both types of accounts help your investments grow faster because they aren't getting hit by taxes along the way. And don't forget about employer matching contributions. If your company offers a 401 match, that's essentially free money going into your retirement account. By contributing the maximum allowed, you're not only taking advantage of tax benefits, but also boosting your savings with your employer's help. It's one of the simplest strategies to ensure long-term growth and maximize your retirement nest egg while cutting down on your current tax bill. Take advantage of lower long-term capital gains rates. When it comes to selling your investments, timing really matters. If you sell an investment after holding it for more than a year, you qualify for long-term capital gains tax rates, which are much lower than the short-term rates. This simple strategy can help you keep more of your profits instead of giving them away to taxes. Short-term gains on investments held for less than a year are taxed at the same rate as your regular income, which could be as high as 37%. But long-term gains are taxed at a much lower rate, typically 15% or 20% depending on your income. That's a big difference, and it's why holding onto your investments for a bit longer can really pay off. By planning your sales to take advantage of these lower rates, you can maximize your returns and minimize your tax bill. It's a smart and straightforward way to reduce the taxes you owe, while letting your investments grow. If you're thinking about selling, make sure you've held the asset long enough to get that lower tax rate. It could save you a lot in the long run. By using these tax strategies, you'll be able to keep more of your hard-earned investment gains. If you found this video helpful, make sure to like, subscribe, and hit the notification bell for more tips from the Money Blueprint. Stay tuned for more ways to grow your wealth and make smarter financial decisions.